Welcome to the Module 2 of the Open Learning course on a primer on Retail Central Bank Digital Currency. I am Srichander Ramaswamy, Director, Financial Stability, Supervision and Payments. First, let me begin with the disclaimer that the views I express do not necessarily represent the views of the SEACEN Centre or its member central banks. The Module 2 covers the topic Introducing Retail CBDC into the current monetary system. Before I begin with this module, let me recap what we covered under Module 1. We examined the roles of the central bank and the commercial banks and how central banks influence lending decisions of commercial banks through instruments like policy rates, cash reserve ratio, and asset purchases. We highlighted that central banks cannot control spending or investment directly, but they shape incentives and financial conditions that guide economic activity, and that the agent for doing this is the commercial bank. In Module 2, we will be covering the following topics: Retail CBDC design choices, the two-tiered monetary architecture, how retail CBDC issuance alters central bank and commercial bank balance sheets, and implications for financial stability and monetary policy transmission. The introduction of a retail CBDC requires careful design choices across multiple dimensions. They include, among others, the following: the level of anonymity of CBDC transactions, the architecture for administering CBDCs, ensuring interoperability in the existing retail payment ecosystem, applicable interest rate on CBDC holdings, caps, if any, on the holdings. We will review each of these items, including the key debates and the emerging consensus on these items. So what are the design choices? One is the level of anonymity of CBDC transactions. Ensuring the CBDC shares the same level of anonymity as cash when making payments is often a preferred design choice in several advanced economies. That is because most central bank CBDC projects are marketed to their constituencies as complementing cash rather than replacing it. Still, the emphasis on anonymity of payments using retail CBDC in an era where social media rules our daily lives and there is a great desire to tell the world what we are doing every minute, I find this requirement hard to understand. Taking this feature into consideration is likely to restrict the CBDC to be designed using a token-based system employing a distributed ledger. A general feature of the token-based design is that it relies on the identification of the object being transferred as a means of payment rather than relying on identification of the individual whose account is being debited. Ownership is verified by possession of the token itself, like holding a banknote. That provides anonymity when transactions are made. Transferring CBDC in the form of electronic tokens between two parties will require third-party involvement. It will also require building strong safeguards against counterfeiting and double spending. Both these requirements can result in high costs and slow speed of transactions relative to cash. The second one is the architecture used for administering retail CBDCs. There is little appetite for the central banks to provide direct accounts on their balance sheet to the public. The central banks tend to favor a two-tiered account-based CBDC administration where an intermediary holds accounts for retail customers. These CBDC accounts will be reflected as a consolidated claim on the central bank, and this architecture is referred to as the intermediated CBDC design. It's important to emphasize here that an intermediated CBDC design does not ensure complete anonymity of transactions. This is because the central bank will have to maintain for each bank a register of individual CBDC accounts and the outstanding amounts in them, because these accounts will have to be ported to another bank if the first one fails as being resolved. But this could be done through a third-party service provider. AML-CFT compliance requirements will also require some form of tracing of the CBDC transfers and payments. Any e-money payment can never fully replicate anonymity of cash transactions. Turning to the next one in the list of design choices is ensuring interoperability in the existing payment ecosystems. Now, advancements in payments technology and the adoption of the ISO 20022 standards in many countries have ensured that interoperability across different forms of money and its acceptance across different payment interfaces will not pose many challenges. Payment service providers are also well equipped to handle transactions involving the traditional two-tiered account-based system that an intermediated CBDC design will offer. Therefore, ensuring interoperability of retail CBDCs across different payment platforms is therefore the least of the concerns for a central bank. The next is applicable interest rate on CBDC holdings. If a retail CBDC is considered to be digital equivalent of cash, CBDC accounts should pay no interest. Some theoretical models discussed in the literature debate whether interest rates on CBDC can be used to steer monetary policy. But the consensus is that the retail CBDC accounts will not accrue any interest. So turning to the last one in the design choices is caps on retail CBDC holdings. The existing design choices impose cap on retail CBDC holdings. This will make a retail CBDC unattractive for many to hold with a cap on holdings. I will discuss the implications of imposing a cap on retail CBDC holdings in the next module. But for this module, I will assume that if a cap exists, it's quite high. Let me now turn to the intermediated two-tiered CBDC architecture. So this figure shows you how an intermediated CBDC architecture can be designed. On the left side is the central bank balance sheet. Again, as we saw earlier in the module 1, you have on the asset side net foreign currency assets, domestic assets, commercial bank lending, gold, and other assets. And on the liability side, it is cash in circulation, bank reserves, central bank liabilities, and you have a new item, which is the CBDC that the central bank has issued. So we have CBDCs consolidated from Bank 1, Bank A and Bank B, which is shown as one item. And then you have equity. So that's the central bank balance sheet. Now, turning to the right side of the figure, you have the balance sheet of the commercial bank A. As usual, the asset side has securities, loans, and reserves. And on the liability sides, it will have deposits, bank debt, and equity, and other items. But now it has an additional item, but is actually not a liability of the commercial bank. What it is offering is an account for the retail CBDC holdings. So customer 1 can hold a retail CBDC account, and the bank A may do the KYC and onboard the customer, but it's not a liability of the commercial bank. And that is the reason why I showed the assets and liabilities as one line here. and then the CBDC holdings of the customer 1 and 2 sitting outside of the liabilities, because those liabilities, the liabilities it owes of the customer A and the customer 1 and customer 2 that the commercial bank has, actually is a liability of the central bank, which is shown as a consolidated liability of CBDC Bank A. Same way, you have another bank B, which has its assets and the standard liabilities, and the commercial bank B is also onboarding other customers for a CBDC, retail CBDC account. So it onboards customer accounts, customer 3, customer 4, and it does the KYC for these two customers, and it onboards these customers, but again, it's not on the liabilities of the commercial bank. They are liabilities of the central bank, and the consolidated liabilities of customer 3 and 4 is shown as the CBDC of Bank A. Basically, it is the liability of the commercial bank through this two-tiered architecture. Essentially, it is not directly that the central bank is onboarding customer 3 and 4, rather it is doing through an intermediated architecture where the commercial bank onboards these customers, and then it actually transfers that to the central bank. So this is the intermediated architecture we talked about, where the commercial bank plays kind of an intermediation role, or it provides a two-tiered architecture where the commercial bank provides this service. Now, shifting to the next slide, it shows the retail CBDC shifts some profits to central banks. So how does the retail CBDC, issuance of a retail CBDC, shift some profits to the central bank? So let's again look at the central bank balance sheet. So the central bank balance sheet has foreign assets, loans to banks, government securities, gold holdings, and other assets. Now, I have shown a separate line item under the assets of the central bank called securities plus 100. On the liability side, it has currency in circulation, bank reserves, non-monetary liabilities, government deposits, equity, and a new item called CBDC plus 100. So essentially when I say plus 100, it's the CBDC, which is a liability of the central bank. There are $100 of the CBDC liabilities, and this $100 of CBDC liabilities, which it owes to customers, retail depositors, is balanced against an asset it has to purchase to match the assets and liabilities. So it has to acquire $100 of securities. Let's say it is government securities it actually buys, which will be backing the retail CBDC it has issued to the customers. Now, on the commercial bank balance sheet, you have the assets, the currency involved, an ATM. You have bank reserves, the government securities it holds. Now, the bank loans shows that there's a reduction of $100. And you have other assets. So on the liability sides, it shows deposits less $100, loans from a central bank, bank bonds and interbank loans, certificate of deposits, equity, and then there is an item which is a CBDC plus $100, but it's not the liability of the commercial bank, so it sits outside its balance sheet. So where does this 100 come from? So essentially, we are assuming that the customer, the retail customer, suddenly sees the option of holding a CBDC account, so transfers $100 of his holdings in the bank deposit into the CBDC account which the same bank offers. So when the commercial bank loses $100 of deposits, it will have to sell $100 worth of bank loans. It could also sell $100 worth of government securities. Again, the decision will be based on whether the commercial bank actually wants to reduce its government securities, and therefore by selling those highly liquid assets, it's going to reduce its liquidity coverage ratio, so it may probably prefer to reduce the bank loans. So the title of this slide is Retail CBDC shifts some profits to the central bank. So question is, how does it shift profits to the central bank? Well, the central bank has additional net income. Why? Because it's acquiring CBDC, $100 worth of CBDC. What's the interest that it has to pay on the CBDC liabilities it's acquiring? Zero. It's now using those CBDC liabilities to acquire, let's say, government securities. Let us say that the government securities have a 4% interest. So it's accruing 4% interest, and it buys $100 worth of these securities, which will give the central bank a 4% interest on that $100, and it's basically has to pay nothing for the liabilities it acquires. So there's a $4 an annual profit of $4 by acquiring $100 of a CBDC. Now, if we go to the right side, what happens is that the commercial bank has lost some deposits, and it has also lost some bank loans. So when it's deleveraging, the commercial bank is deleveraging, naturally its profitability is going to fall because it has lower amount of assets, less deposits, and the net result is going to be that it has lower returns. And essentially that lower net income is basically coming from the fact that the central bank is actually going to accrue some of the benefits of this lower income. So there is, in some sense, you can think of it as a profit transfer from the commercial bank or the private sector to the central bank or the government. Now, what options does the commercial bank have to avoid deleveraging? So we start with the assumption that $100 of retail deposit moves to a retail CBDC account. And that retail CBDC account of $100 becomes the liability of the commercial bank. Said earlier that against this liability that the central bank has acquired, it has to buy government securities worth $100. Well, the central bank can do one thing. Rather than buying the security worth $100, it can extend a loan to the commercial bank worth $100 against the acquired liabilities of $100. And this is now, you can see the loan being extended from the central bank to the commercial bank. And the loan that it has received from the central bank, this $100, offsets the deposit loss so that the net liability change is zero. Therefore, the commercial bank will not have to sell the bank loans, or in other words, it does not have to deleverage. Now, even under this case, even though the total liabilities and the assets and liabilities of the commercial bank has not changed because of this loan being extended by the central bank, the cost of funding for commercial bank goes up and the profitability falls. Why? Because typically when the deposits are, let's say they are demand deposits, they pay no interest, and when the commercial bank receives a loan from the central bank, they are at market interest rates, and at the same time the commercial bank will have to post collateral against these loans it receives from the central bank, and that can cause asset encumbrance on the commercial bank. And that will have implications in resolution, bank resolution, because a lot of the assets are encumbered. Then you have a problem of resolving the banks in a stress situation. So now you can also think of other options to avoid deleveraging by the commercial bank. So here is another alternative that the commercial bank can think of. Again, on the central bank balance sheet side, the central bank has acquired or got $100 worth of liabilities in the form of central bank digital currency, and against that it has bought securities worth $100. Now the commercial bank liabilities, the deposits, reduced by $100 because that goes into the CBDC. In theory, it should reduce its loan supply because it has lost $100 of liabilities, but the commercial bank can say that I'm going to issue short-term debt, short-term certificates of deposits, and I'm going to issue $100 worth of certificates of deposits to offset the loss from the deposit funding. Now, one more, again, the same profitability issue comes up, because the certificate of deposits that a commercial bank issues will be at market rates and typically higher than the deposit funding cost for a commercial bank. And if the deposits that have left the commercial bank into the CBDC are primarily, or let's say predominantly, from demand deposits, which typically pay no interest, you're going to have to fund this $100 certificate of deposit at market interest rates, and naturally this is higher than the deposit rate funding, and the net interest margin again on the bank loan that you had extended, the commercial bank has extended, is going to be lower, and naturally the cost of funding is higher and the profitability will fall. Let me now turn to the implications for financial stability and monetary policy due to the introduction of the retail CBDC. Now, the current monetary system is based on fractional reserve banking. In fractional reserve banking, banks are only required to keep a fraction of the customer deposits in reserves, either as cash in their vaults or deposits at the central bank. The rest of the deposits can be loaned out to borrowers or invested. The retail CBDC can disrupt this process. Will other players, such as non-bank financial institutions, step in to fill the credit supply gap? Well, banks will find it unattractive to seek alternative funding sources if a large share of their unremunerated deposits, like the demand deposits, migrate to CBDC accounts. Big tech and large e-commerce firms that have been waiting for many years to enter the lending business will find it attractive to exploit this credit intermediation gap left by the introduction of a retail CBDC. Question is, how will they fund their liabilities? Well, they can issue bonds in the capital markets, and the central banks themselves may be willing buyers, as they will have to gather assets to back their CBDC liabilities. To the extent that big tech firms do not have to get a banking license and face regulatory burden, they will provide trade finance and investment credit to suppliers who sell products on their e-commerce platforms. The cash flows from the items sold could be used as collateral for the lending. Now, will central banks be able to steer monetary policy and credit supply when other agents supply significant share of the credit? Conventional monetary policy instruments rely on the ability of central banks' policy rate to have impact on their amount of credit supplied by the banks to the economy, and through this, the overall growth. A material decline in the share of bank credit to the economy will reduce the effectiveness of bank lending channel in the monetary policy transmission process. The entry of big tech into the lending market will make the balance sheet channel for monetary policy transmission important if the credit supply through the bank lending channel falls. But central banks' ability to steer credit allocation decisions of non-banks can be difficult. For example, non-bank actors like big tech do not have to comply with cash reserve requirements. Consequently, central banks will have fewer levers to pull when trying to regulate credit supply. Now, will central bank balance sheet size become more volatile with central banks having little control over it? If we take the current arrangements where the retail CBDC accounts earn no interest, periods when policy rates are higher and bank balance sheets are perceived to be strong, there will be less demand for CBDC. On the other hand, periods of heightened risks in the financial sector will create a large demand for CBDC. The changes in CBDC holdings on which the central bank has little control will lead to an expansion and contraction of the central bank balance sheet over which it has little control. The changes in balance sheet size driven by the liability side of the balance sheet will force the central bank to become more active in buying and selling securities in the market that can send wrong signals to the market participants. Now, will the central bank's mandate on safeguarding financial stability be compromised? Well, challenges to monetary policy implementation in turn are likely to have detrimental consequences for safeguarding financial stability. One source of risk to financial stability can flow directly from the central bank balance sheet. To avoid the political economy questions highlighted earlier, central banks may end up investing in sizable share of their CBDC liabilities in non-government securities. This will result in their balance sheets being more exposed to credit risk than they are used to. Less liquid and more risky central bank balance sheets will raise credibility questions on their role as lenders of last resort function. This will diminish their ability to mitigate financial stability risks in times of stress. That in turn can compromise their independence. Financial stability risks can be amplified if problems in some banks, as the recent failure of the Silicon Valley Bank showed, lead to a large depositor withdrawals from several banks. So far, such runs have shifted money from one bank to another bank, but the money remained mostly within the banking system. Uncapped retail CBDC will change this, as the flight of deposits will result in money leaving the banking system. The ease with which such shifts can happen in a digital economy will make the need for central banks' provision of emergency liquidity assistance far more frequent. Safeguarding financial stability would become much more challenging for central banks when retail customers and businesses have access to CBDC accounts. As a central bank becomes everyone's deposit taker, it will also become everybody's lender and crowd out private intermediaries. Now, these are practical questions that the central bank needs to examine before introducing a retail CBDC that allows consumers to buy more just than groceries. Let me conclude by saying that the introduction of the intermediated retail CBDC will make central banks look operationally similar to a traditional bank. That is because they will be seen as raising debt at zero interest rates by issuing retail CBDC liabilities and then lending them to the government or to the commercial banks against safe assets as collateral, and in the process generating a significant net interest margin. Central banks can quickly come under criticism as market participants will see them as running a large carry trade to the detriment of the private sector and to the benefit of the government. If more of the CBDC liabilities are used to fund government bond purchases, central banks will be seen as implicitly subsidizing government financing. These central bank operations will have a political economy implications, and as it will occur at the expense of private sector and the taxpayers. So, thank you very much for your attention, and I hope that you will continue with Module 3, which is the last module of the course on Retail CBDC.